It's Friday, February 14th. I'm here with Ed Matz, and I think we're going to be talking correlations today. Good morning.
Yeah, it's very good morning. Good morning, everyone. It's probably better to speak about something like correlations than the lack of Valentines that certainly come my way. Although you've just very kindly sent me one because you knew I was upset. But what I found interesting about a lot of the subjects we've been talking about is, I mean, they're useful, really useful exercise for me, but I think for people generally to think about some of the things you do and try and crystallize them, make it more logical so you understand it. But more importantly, how do you apply? It's all very well me or us producing quotes and some theories and some ideas for people to go away and think about. But the real issue is how do you apply some of these ideas in a very consistent way? So what I wanted to do is break down correlations today, find out what they really are about, uh, because there's a few cliches that surround them. But also at the end, really kind of talk about how we can trade them and how we can translate some theories, some cliches even, and translate it into money. Which is why I've hopefully we've got a guest, a guy called Blake Morrow from Wise Trade. He's one of the nicest guys on Twitter. He's a really nice guy. He's a really good trader. And one of the ways he is a good trader is he can take the approach of correlations in the market, and how you trade that today, which is kind of how I wanted to finish it. So Blake will be coming on hopefully before he does his own webinar, and I was going to say watch the space, but actually I got a surprise for Blake, and I'm sure one or two people, if they know me on Twitter, will probably have guessed what the surprise might be. But that's for Blake hopefully later in the day. So let's move into straight away to correlations. What are correlations about? Well, correlation is an Italian copper pot. You're going to hit me with some interesting charts there, aren't you? Um,
Yeah.
which is not a good place to start. I think let's step back then before we go into something like an Italian copper pot, and you really confuse me. There's a great quote from a guy called Bruce Kavanagh, Caxton Fund Management, serious money, serious guy. Really worthwhile reading him, and I've forgotten his mentor, Marcus, isn't it? Mike, is it Michael Marcus, who he learned from? I think so. It's funny how, you someone like Bruce Kavanagh, I think is a great trader. He brings everything together, a macro trader, but it brings everything from a trading point of view together as well, some of the concepts. And yet he has his own mentor. It's funny that, isn't it? You think of some of these great people, probably Jesse Livermore had his own mentor, and everyone needs someone to help you stay focused and disciplined, and to do well. But uh, right, he's that's the wrong quote, Bruce. It's very
Oh, yeah. There's more.
Yep. The one is the very first one, right up front, kind of describes trading and it hits it on the nail. It should be what's the top left of the sheet. I don't know
Oh,
where that's gone now, but basically Bruce Cutler
yeah.
actually
I can do it. Yeah.
almost paraphrased Paul Tudor Jones when he said that trading is like chess. And what Bruce Kavanagh basically
Market analysis is like a tremendous multidimensional chessboard.
Yeah, I mean, basically, that's for him. Trading was, everyone trades the market. Not everyone trades it a different way, but a lot of people trade it in different ways. And trading is like a multi-dimensional chessboard. It's bringing all those pieces together, and what they and trying to make sense. Not always having all of the pieces together and for it to make sense, but enough of the pieces that you can see the shape of what's going on. And I've talked about the need for continuity, or continuum on which to trade, on which to operate a narrative, if you like. But that narrative is built by a whole series of interrelationships, how markets relate to each other. We'll look at somehow, some of the currencies work together because people know that's kind of what my background. But more increasingly, I trade the whole gambit, and particularly stock indices, and how they relate to other sectors like the bond markets and commodities. And winning commodities, is gold part of that or separate? Issues like that are always moving. And I think to understand correlation You need to understand those separate links. I'm trying to think of an analogy here. Like there's a children's toy, isn't it? When you put bits together and you can change them around, and each day it changes around. Uh,
What, Lego or
uh,
Jenga or
no, not Jenga because that falls down.
exactly.
Hopefully, well, it does. Let's be honest. Sometimes they put the construction together, got it, looks really cool, and then suddenly it collapses, and how are you left? Well, it's better to have it collapse and start to rebuild it, than to take the analogy too far. But okay, what is a correlation? I'm sure some people. I remember doing correlations in my advanced GCSE, as it was then, and falling asleep. What is a correlation? There's a definition. We have a definition. In fact, I think I wrote it. Sorry.
Yeah, it's right here.
Yeah, it's my definition, so apologies, because I looked quite a few definitions out there. I didn't really think it's not the relationship between two markets. It's the extent to which a relationship between two markets changes or doesn't change over time. When they move exactly together, what's the guy's name? What's the phrase called? I was going to look it up now. There's a name for the coefficient. I'm trying to think where it comes from. It begins with a P, but anyway, that's beside the point. When they move together exactly, let's give a coefficient of 1. It's 100% correlated. And when they move the opposite direction, it's -1. It's minus 100%. There isn't such a thing, but there is a coefficient of -1. And when they move independently, there is no correlation. It's random. It's therefore 0. And so, you can take two markets that are similar and they move together, and therefore the correlation of 1, and two markets that are different and they move together, and the correlation is still 1. And it really begs the question why, therefore, they move together, or why some markets that move together don't move together that should.
Yeah.
And the question is to understand why that is. And the most famous cliche of all, I've seen it tweeted many a time, I think I've tweeted myself many a time, is that correlation does not necessarily imply causation.
I think I've been guilty of that a few times.
Sorry?
I think I've been guilty of saying that exact thing a few times.
Yeah, we all think we're clever by saying it, and we are, because it's true. Correlation doesn't imply causation. In other words, the fact they're correlated doesn't mean that one is causing the other to move. Intrinsically, I should say, because I almost slipped up there. But then let's throw it on the other side. Well, let's, in fact, let's choose one of the most. Who's the most famous predictor you know of in the last few years? Nate Silver, yeah.
Silver. He's got a simple model, actually, surprisingly simple. Like when you really look at it, it's common sense in a way.
Oh,
but it's working.
Who was it said that genius is just common sense simplified, or eloquent common sense? It's, the guy's a genius, yeah.
Nate Silver, or the guy who said that?
Well, he displayed signs of being a genius. Anyway, I'm sure he is a genius, actually. Can you read out what he said?
Yeah. Most of you will have heard the maxim, correlation does not imply causation. Just because two variables have a statistical relationship with each other does not mean that one is responsible for the other. For instance, ice cream sales and forest fires are correlated because both occur often in the summer heat, but there is no causation. You don't light the patch of the Montana brush on fire when you buy a pint of Haagen-Dazs.
Well, I'm sure someone can find some sort of causation that would prove the theory. In other words, people buying Haagen-Dazs ice cream, take it on a picnic, and then they go into the forest, and in the picnic they have a barbecue, and next thing you know is every time someone eats the ice cream, there's a forest fire. I mean, there are some strange things, and it kind of gets on to the subject. What I wanted to talk about is why we do have correlations. And then one thing I put together is a little kind of, it's probably not an exclusive list. I actually did a paper on causation at Oxford. I was much stronger at economics than philosophy, but I actually wrote a paper on causation. So this kind of interested me a little bit.
When was that? That's got to be a while back.
Sorry?
That's got to be a while back, right?
A couple of years.
Yeah, a couple of years. No, you've been interested in this in a long time. That's what I mean.
Yeah, no, and it does touch on the nature of causation. So if you got the thing I kind of put up.
Yeah.
I've got one of our guests is saying. Uh,
They're waking up in the US.
yeah, yeah. Right. Can you? I can't see that even.
Oh, there's a long list here. We're gonna tweet this out, by the way. You have already tweeted this out, I think, so people can follow if they want to look closely. And if we
I
don't,
hopefully haven't tweeted that. I didn't mean to. I didn't.
did you? Okay.
No, I didn't tweet that.
Maybe
Basically,
they
we're
find
starting
it.
with the obvious point.
But
Correlations exist, right, due to several factors, if you want to call them. I've classed them to groups. If I wasn't so fond of fractals, we'd be talking all C's. Yeah, I mean, I might find another word because at the moment it's 5 C's if I can rename fractals to C's. Oh, funny that I managed to get fractals into.
yeah, it's interesting, huh?
Anyway, right, the obvious one. Let's deal with the obvious one. Right, and there's an obvious point right up front. Okay, correlation doesn't necessarily imply. Correlations don't necessarily imply causation, but neither does causation necessarily imply. Correlation, nor does correlation actually mean there isn't any causation. Because clearly the most obvious correlation exists where when you get cause and effect. When you do, it's not the correlation isn't between the ice cream and the forest fire. The correlation is between barbecues
Yeah.
and the forest fires. Yeah, I mean that's causal because people throw away the match or whatever, and that creates the forest fire.
Yeah.
How does that mean? Okay, well that's interesting. Not how does it? How can I take that? The causation. There's so many causal links in the markets. One of my theories is that there are so many. The reasons why so many of them, like the fundamentals, don't appear to work so well is because there's so many moving at different times. You can't always see the wood for the trees to bring in that fire again.
Yeah.
Okay, the obvious one is that global economic growth drives up stock markets, creates inflation, and therefore bond markets goes down. And therefore, you could say that, okay, there's an indirect causal correlation between stock markets going up and bond markets going down, although we've obviously seen the opposite. You could therefore say the causal link of the stock market going up has been a flood of money from quantitative easing, which obviously is represented by the bond market going higher. So there's a strong correlation currently between bond markets going up and stock markets going up, and the causal link is quantitative easing. How does that mean in currencies? Well, you can take something like in Europe, where there's you might see I kind of think the yen cross has been a bit toppish the last 48 hours.
Yeah.
And one of the reasons, one of the backgrounds why they've come off is I think you may find this a little strange, but there is a correlation there between for example, with European Eurozone deflation. The euro's come off and therefore has dragged down euro yen, and as a consequence, Swiss yen has come down. So Swiss yen and euro yen are correlated. Euro, and more importantly, in terms of a causal correlation, the Swiss is being affected by eurozone deflation, and that's why they all move in sync, partly, and also partly because the Swiss National Bank has trapped it. Okay, so that's why some markets are correlated, fairly obvious fundamentals. I'm sure there are other factors I can add into why markets or may move together, why the causes might affect correlations. But one of the biggest ones, over and above that, is the perception of causation, that people do see the link. So, bond market goes up. Let's say, take it the other way around. The stock market goes up. Janet Yellen says she's a little uncertain of employment and therefore a bad NFP, so the bond market starts ticking up because they're not going to do taper so fast. I'm just making this up as an example, but you've seen good examples of this.
Yeah.
Net result is the stock market goes, bond market goes up, stock market goes up. Why does the stock market go up? Because everyone in the stock pit, the S&P pit, has seen them buying them in the bond pit, and so it's not just. There is a causal link. People see it, and if one market is not there, then what you see is you see the arbitrages. Yeah? You see it instantly. They see it ticking up in one market, they'll tick it up in another. There are programs, algos that will actually enforce correlation to the tick. I mean, and it's been around for decades, where you'll see arbitrages will ensure the correlations hold true, unless there's some sort of fundamental shock.
Yeah.
You'll see people, and some of the
But do you think
Sometimes it,
market have been inherently more correlated now? We've seen risk on, risk off for years until like 2012 or 2013. And we saw markets just move in just like these waves of waves, just on and off.
yeah, definitely. And it's been reinforced by the correlation. It's one of those. The perception is that market, risk on, risk off. Got the HSBC index. Everyone started talking about it post crash because it's interesting. It started with a shock. I'm a great believer. I've talked about this as the risk train before. When the train stops at a station, people get on and off. Different markets get on and off in different ways, but there's a stop, and then there's a shock, and then the market realigns itself and comes out the other side. When we had the crash in 2008, since then, markets have been extraordinarily correlated.
Yeah, as
Yeah, and it was
seen
to the
by
extent,
the HSBC
I
chart.
mentioned it
Yeah,
before, some of the great trading moments where S&P limit down, you can't touch it, whack. The yen's disappeared for 2 yen because it's doing the trading that the S&P would be doing if it weren't limit down.
yeah,
And it's that type of understanding that people will enforce. They see a causality, they see the link, they understand the link. If they understand it, there's more reason why they'll go after it. Um, and therefore, you see what you'll see is a double jump. Sometimes you'll see that uh, the market will correlate to the cause.
yeah,
So, for example, let's say for whatever reason, let's say choose a market. Let's say the S&P is shut, it's limit down or something. Then AIG folds. Yeah. Then the yen is moving. It doesn't matter what the S&P would be doing or
yeah,
whatever. The yen, people are hitting the yen because they know it's risk off. It's risk off because it's highly correlated to the cause,
yeah.
which is in that case is subprime. So don't dismiss causality because of that cliche. Yeah,
No,
causality
exactly.
is the driving point, I think, beneath all these correlations
I
and
remember something interesting.
relationships.
I remember an interesting
Sorry.
example from this. Remember when they had in 2009, 2008, 2009, when you had these short bans, short selling bans, and
Yeah,
you saw they had short selling bans on banks. I think it was 2011 in France, and you see DAX getting hit like in seconds, just getting destroyed, like a couple of percent down in a few seconds. And like when you're like doing the going back and trying to figure out what happened, it turns out that it was probably a proxy for it, similar to what you're saying now. It's interesting. It's like causality that you would never expect to be there.
yeah. Well, what I'm saying is now that's correlation, but it's happening because the cause is correlated to cause. So the DAX is directly caused to a ban on the stock market is stop selling short. The stock market is not a market, so you can't correlate it, but it's correlated to the cause, is affected by the same cause. So the classification, how people see it, is really important. And that's the next point. Is what's happened, particularly since 2008, is the classification of correlated assets. Um, Markets. It's been going for a long time before that. People were creating currency baskets and trading in and out baskets. Some of the cleverest guys I know at places like Morgan and Chase and bankers, so they were trading baskets, their own baskets. They would create baskets of correlations and trade them, throw something out and trade it against it. And some clever guys, but clever trading techniques. And so when people see put them in baskets and see there's a common link between them and the classification, you necessarily increase the correlation. There's a great chart. Have you got I don't know if I put it in actually. Have you got a CAC and Aussie it's a
Yeah,
Peach Melba chart? I like this chart for a number of reasons. One, because there's no reason why these two markets in themselves would be correlated. But you can see prior to tail end of that the yen bull market 2011, that market was heavily correlated.
yeah,
Now, I call it the peach Melba because I can't find any obvious link between France and Australia. And the obvious link I could, well, the link I found was a guy called, is it Costofio? I forgot now. He was in love with an Australian singer. Anyone who's watched Downton Abbey might know have heard of Nellie Melba, and he created a dish called peach Melba for her. So that's the only link. So I call it the peach Melba trade, because I actually trade this because they're so correlated.
Yeah.
And then you can see with the yen, the rampant, the quantitative easing has broken the correlation. And you see, the red box shows the difference. And now, interestingly, how the peach Melba is back on the menu. Why? Ask yourself why. Why does that happen? Why are they so correlated? Why historically? The reason is because they're both part of what is called that risk, that global asset class, the risk class. That as you think the world is doing well, then then people will buy, obviously buy the French stock market, but at the same time, the Aussie dollar is a carry trade. It's seen associated as a higher, as a risk appetite currency, and as a result, people hold it for the carry, and so it will go up. And the yen is the opposite. Yen is the vehicle you use for a risk aversion. You buy it and you sell the yen when there's risk appetite.
Yeah.
And so Aussie yen is one of the purest typically one of the purest risk pairs there are.
So that's the purest risk on, or risk off, I guess.
Well, it is, but it's been slightly affected by the yen of late because I would argue, Sverre. I mean, I don't really want to. Well, I was going to talk a bit about uh, whole risk concept later,
Yeah.
but let's move on. It's so there's a classification is important. Classification, not just the arbitrages, but people's mental classification as well as official classification increases correlation, and then clearly again perception of a common class. People will know I was going to include this slide, but I haven't got it. I think I might have included it previously. Some people have seen me with, say, Dale. I've shown, and then also in a seminar with Ashraf Lady at City Index, and also his own shop, um, have seen me draw a triangle, which I think is the most important. It's funny, what I think is the most important correlation for the next year, I haven't actually included, is and has been the correlation between the S&P, the Nikkei, and dollar yen, what I call the triangle. I'll tweet a chart of this later probably, but it exemplifies how everyone knows that the Nikkei, now they know the Nikkei is clearly moving with dollar yen. You just need to walk in one day and find everything is up 1%. And it's also no surprise to find the S&P is doing the same thing. You could argue one of the reasons why you try and clutch for straws, why, apart from the fact it's so obvious it is happening, is quantitative easing in Japan is going to help Asia and therefore will fuel US growth even further. Well, I don't know, it's a bit tenuous, but the fact it exists means we can trade it.
Yeah.
Um, then you want to look at some of the reverse it, because this is what happens if most of a lot of words there, a lot of correlation is about perception. Then when people see the effects of a correlation, then they know the cause, or believe the cause must be there. So if people think that the Nikkei is leading, let's say the Nikkei is leading the S&P and dollar yen, and they see that the S&P is higher, they'll go, and the Nikkei hasn't moved, they'll go and buy the Nikkei. In other words, the process is reversed, and that is like a self-fulfilling. Again, the market helps maintain the correlations if nothing happens. Um, yeah, the our other guests, not Blake. He
Yeah.
keeps Skyping very.
Yeah.
Can you get hold of him?
I'll try. Should I bring up the Nikkei Citibank chart here?
Um, no, not yet. No,
Yeah.
come in. Sorry, people. I'm just. Someone keeps messaging me who I kept online intentionally because I wanted them to come on. Um, okay, yeah. Let's fractals, right? Let's say people see things and they become self-fulfilling, and that's why the correlation exists. then people like me will spot fractals, will spot similarities, and therefore help them to exist. There are some markets that correlate, appear to correlate, that appear to be no reason, and yet you ask yourself why. Now, can you put up that chart of Citibank, Barratt Development, a UK property company, and the Nikkei. So you basically got a stock index, you've got a US bank, and you've got a UK property market, and they are correlated quite clearly. This is a slightly old chart I produced the tail end of last year, inspired by a good guy, an Italian friend, Imano Cantoni. Really clever, some things he comes up with. But that was a cool spot, and you can see those markets are moving together. They're correlated, but why? Now, at the time this came out, I wanted to use that as an excuse, an opportunity to explain that sometimes the reason why that could be is because people are following one against the other. No, not in this instance. It could be that there's a common cause, risk. I think it could be a driver behind those three markets. The whole risk class is moving in a very similar way. This is how, more importantly, how risk assets like to trade in an uptrend. And therefore it becomes a template. This is one of several, not that many. You'd be surprised how many there aren't, templates of how a market moves in an uptrend. So you just pick three not related necessarily related markets, and say they're in uptrends, and lo and behold, they're trending in a very similar way. So it could be coincidence, which is one of the points you see time and time again. You see markets are correlated. If you can't find a correlation, it's two things. It could be a coincidence, and the second point is, who cares? Who cares? If the correlation stays intact, then you can trade it. The only problem is when you don't know the cause, you can't necessarily spot it before it breaks down. Um, and Barry, you mentioned Barry the other day, didn't you? I think.
Yeah, Ritos, yeah.
Yeah, about what's he called? Reform broker. Yeah.
Yeah, I have him here. Ready for you?
Do you want to read that out? His quote.
Yeah, one second. I'm just gonna bring him up here. It's the data overwhelmingly shows that most of the time stocks and economy are wholly uncorrelated. Over the short and medium term, days, weeks, months, there is almost no relationship in either direction or magnitude. People often have difficulty accepting that, but the academic studies on it are overwhelming. I think that's a great point.
Oh yeah, but why? I mean, why does that exist? And I would argue it goes back to the structure of so many links. And the problem with the structure is it's not stable. It's dynamic. It's moving all the time. So today, if you think, for example, we have been driven by quantitative easing into a recovery, and therefore economic recovery, and bond markets are the main drivers in the market. So anything that correlates with those two is going to correlate to themselves. Whereas, let's say there was a flare up in the Middle East and oil became the question, then the correlations on risk might be dissipated, might be reduced, and correlations with oil might come to the fore. Point I make forever is understand what is driving a market and follow what's driving a market. And then you've got a better understanding as to possible correlations. But again, let's say, there is a flare up in the Middle East, and then Yellen says something about, I should call her Janet, Mrs. Yellen, says something about taper, and whack, it comes in a kilter. So there's so many variables that it's no surprise that obvious things that should correlate don't always correlate, and they also get skewed. So let's take the classic. Can we take the classic correlation?
Yeah.
The famous risk on and risk off, because that came to the forefront and said after the crash, and people started following that and doing some clever things. HSBC's risk on risk off index, you can see is the red. It's not up to date. I haven't seen an up to date one of it, and correlations have. Were pretty strong, certainly in the decline, and as the market came out and rallied strongly in the back for the last 18 months or so, the correlations have stayed pretty much there, except recently. Again, anyone who attended the City Index seminar will know I talked about how correlations. It's part of my best fits approach. Fits being intermarket relationships is the eye of fits. How correlations break down at this point. And since in this year, you've seen correlations, the individual components of the S&Ps have been at the lowest point since 2007. The correlations are breaking down. And that's telling me, supports my overall view that this is a correction. Typically, if you think about 2007, 2008, the collapse, high correlation, we're not seeing correlation at the moment. So that's kind of an interesting one. Um, and
That
then,
is
they,
actually a
they came
very
up with
good point.
lists of markets that should correlate. I think I've produced a list. You don't need to put it up, in fact, if you don't want to put it up.
Is it this list you mean?
Yeah, you can see as, the market has a risk appetite, certain currently back in the list changes
Yeah, exactly.
as the story, as the narrative,
But
as the drivers behind the correlations change in terms of economic growth, quantitative easing into economic growth, the list does seem to change. And maybe other factors. We've had the Arab Spring and oil-related issues in there that throw out a kilter, and
yeah,
people have generally come to the conclusion, came to the conclusion, 2011 into 2012, that the correlations were breaking down. Lots of risk on or risk off as much as it was before. And the new norm, what's it called? The new normality or something?
this
New
is
normalcy?
remarkable. Look at the dollar. Am I reading it correctly? Dollar was the number one risk appetite, and now it's number one risk aversion.
Hmm.
That is remarkable.
Well, it's
That is a complete and utter flip from. But I understand why. But it's.
well, exactly. I mean, it's the reasons for the correlation have changed significantly from 2005. In that period, you got the classification of risk on, risk off, and it's self-reinforcing in many ways. So, and that helped. It helped in the decline, and it's helped in the bull market. If you kept that perspective, looked at the correlations as a story, as a narrative, it's helped tremendously. Um, what has helped me also recently is a not a new concept, a concept I've mentioned once or twice about the nature of how risk works and why it's not so clear cut anymore. Because there is a concept we see time and time again called risk off. In other words, the stock markets rally, euro yen rallies, etc., not because there's a clear sign of risk appetite because the world is recovering and there's signs of economic growth. What you've seen, and you saw it, and I would describe it as the first rally from the lows recently wasn't risk appetite but risk off. In other words, people were selling that baby, thinking it's going and it's Armageddon. Your Howard again. How many times are we going to mention Howard's quote about the great last chance to sell stocks? And then what happens? It rallies. People like, I don't know. I wouldn't have thought Howard would have been short, but people were buying it. Well, if Howard had a position on the back of what he said, he would have been short. He would be buying it back. That is not risk appetite. That is risk as aversion to risk aversion, where it's going back up. And then this is why it increases volatility. And we talked about sentiment, how it's such a good indicator, and how sentiment actually helps you understand correlations and reinforces correlations as well. Then from a risk off position, understand why that is so violent sometimes, and why once you've got it, and the market drifts back down, that's when you need or you can see risk appetite. And what we've seen in the last week, 4%, thank you very much, is risk off, in my opinion. This is why I think the market's been is vulnerable, because it'll drift off because people don't really want to hold it. They've been hurt. But it's next week, tail end next week, I'm looking for signs of risk appetite. So
How do
I'm
you
looking
think this
for,
week played out? Because on Monday you said you thought it was going to be a quiet week and it's going to be good for establishing a new trend. And it's kind of, I mean, you made a number of like fairly specific calls here, both in terms of assets, but also in terms of like general mood. And it played out almost exactly like you predicted.
yeah,
Would you agree?
well, it was interesting because well, I always get a little worried when, I mean, you were right, and Harry was right to talk about a quiet week. I get worried about that because, as I said at the beginning of the week, when there's a quiet week, you often see true trends, see a true direction. The market may be giving us clues.
Yeah.
I was long stocks, using it. The DAX actually. Let's bring up the DAX because I've now mentioned the scenario I'm looking at, reasons why relating to risk on. Can you put up the DAX chart? I don't know if you
Which?
I sent it's not on the pin. It's
Oh, this
on
one.
the
Yes. The
it's in
fractal
the
we've been looking at every day. I should know it by now.
yeah, I know, isn't it
It's the
boring? But it tells a
Mandelbrot.
story. It is boring that I keep showing that
No, it's not
chart,
boring.
but
It's brilliant because it's right. It's correct.
yeah, well, that's right. Because I'm going back to the point, this concept of volatility. It's volatile, it's moving, it's trending, arguably trending, maybe not, but it's clear. So the combination I call volatility. So it's my key market. It's what I talked about drivers. The DAX may not be moving the market, but it's clearest. So it gives me an indicator, and it's volatile enough. Thank you. And it's probably this last run. It's actually done. The US has gone quiet and the DAX has actually maintained the rally. But now, there's always a question mark. I was saying this is why I'm just staying long this baby, because there's a question mark where it was exactly in terms of the green. Unfortunately, no longer green because of thank you Reuters, changing the colours. Uh, just as well, I'm colorblind. I'm not.
This has been a week of Reuters and it's been a quiet week.
Yeah.
So for you, it's for people who have been watching, like me and Ed, I've been a little tense sometimes, and it's only Reuters related. At
And I
least
keep
that's how
saying,
I.
I'm very aware that look, they give me my platform.
Yeah.
Yeah, I don't. So I've got to be really careful about slagging them off.
No, no, no,
But
it's true.
and it is a really, I'm really quite excited. But I just need to get through everyone finds this with a new system,
Yeah.
the adjustment stage.
Yeah, it's also it demands so much from you though. In terms of that, like it's a very big system now, so it's a big upgrade.
It's really kind of cool.
Yeah.
But I mean, no disrespect to Reuters, it's built for a bank where they're going to have hundreds of these workstations and dedicated computers.
Yeah.
Uh,
How often do you feel you have to upgrade stuff like this, like hardware, and to keep up with it?
I'm always behind the curve
Yeah.
because I don't like. I'm always forced to. I try to when it comes to risk, I try to anticipate the changes.
Yeah.
But with things like this, it's, I got to go out and buy some new equipment because this Reuters, I think. I'm running 16 gigs of RAM. People might think it's not hardly anything, but it's not.
That is significant though. And you still have problems?
Yeah, but I don't just run Reuters on it. This is the problem.
Yeah. Yeah, but
So anyway, that's beside the point. Anyway, but it's a great system. It looks really sexy, and once
yeah.
I've got settled with it, it's going to be cool. But let's go back to that DAX fractal if we can. Basically, what it's saying is what I talked about, going back to the risk off. What we've seen, a large part of this rally has been risk off. If I'm not going to confuse people, and now I don't know how to describe this power because I don't think this is real flow. I think this is. It is still probably the tail end of risk off, and now the market is it's interesting because what it's saying is we're approaching the dog end of the first major rally, and so it actually is worked out. If you not only look at the structures being similar, we've traded it similarly, and it's worked out brilliantly, but the size timing isn't that different either, really. And the size, the points are exactly the same. And it's saying 96.90, what we've been to today, 96. Uh, high on the DAX today. It hasn't been there yet. Oh, I hope it'd be nice if it had. But it's saying we've got a push up the next 24 hours or so. We've got a chance, typical weekend access to push higher, 96.90. Basically, anything above 96 is going to fade, I think, on the DAX into next week. I'm probably looking at it, if it repeats that red circle again, then we're talking about a 94.50, 97 range. And saying it could go, I mean, if it repeats what it did last time, it could go back down to 94.40 again, which is why I'm looking to scale out again. And it fits with my view about the risk off, running its course. The market is now retracing. Let some people get short again. As it comes off, they'll be painting the Wall Street 1929 crash on the walls as they get. The market thinks it's crashing. It might be the opportunity for it to crash as well. But I'll be playing at that side and then looking to buy again. looking for it to establish a base. And the great thing about the DAX fractal is, look, it stabilizes, goes sideways, retests a low. I just love markets. A lot of risk markets do this. Talk about correlations. You look how the yen trades, rallies strongly and back to the lows, gives you one of the most best risk return trades you could possibly hope to see. And the same thing as last time. Look what the DAX did. Went down below 9100 and it was a dream trade. You know, it's always every trade that works out well in retrospect is a dream trade, but that was the risk return probability on this was phenomenal. Yeah, it's gone now. Oh well, hopefully the next leg will be
Yeah.
equally phenomenal.
Are
So
you
how
less?
does-
Do you mean that you're less like sure about the direction, or?
No, just the risk return. You know, your stop is below the low, so your risk return is skewed.
Yeah.
Okay, I want to move on. So, you know, that's some of the I talked about how my thought process is about correlations, how you trade them. You know, well, I don't trade fractals. I think they're a load of rubbish or whatever. So how can I be more hands-on about? Well, the first thing is where markets are correlated. Recognize that markets can be correlated. Have you got the Lipschutz quote?
Yes. Once again.
So how do we use correlations? Need to understand this. I do this. I mentioned this yesterday. Was it the day before? You want to read it out?
Yes. Don't concentrate too much of your money on one big trade or group of highly correlated trades. I have like buying equities in different markets, for instance, I would guess.
Oh no, like doing what I do all the time, and I just have to step back and crunch the numbers.
Yeah.
Yeah, what have I been? I've been long the stock market. I've been long dollar yen. I've been long yen crosses, varying degrees at different times. Um, you know, I've been long the Aussie. You know, that's a beautiful trade from basically from that bottom of that channel support. All related. They're all risk trades. Yeah, I mean, and if I were wrong, if it was a 1929 crash, Aussie would have collapsed, the yen would have plummeted, the DAX would have plummeted, the S&P would have been plummeted. Rather than me going cock a hoop, wasn't that great risk return trade? I probably I've been miserable, might have taken a few days off to recoup or whatever, because you can't escape losses, you can't isolate them completely. I would have been well upset. So bear in mind, look at what your positions are if you trade more than one market like me, and do the numbers, crunch the numbers. How big a position? Crystallize it into an S&P position. Are you comfortable with that amount of risk? So
Is that how you measure correlated risk, or like concentrated risk?
I correlate. Yeah, I do.
Yeah,
I
and
correlate
convert it to S&P
all my
-ish.
positions. Not all of them. Some of them aren't risk positions, but anything like that, I do correlate to
Yeah.
the S. I look at the S correlation to the S&P, and then I trade on the back of that.
Why did you choose that specific method?
By the S&P.
Yeah.
I've got to choose something for risk, and I would like to get a better handle on this risk off, risk on index, but it's the closest thing correlated to risk in my opinion, and I've got a system, and it don't mean that it's not broke. Yeah.
Yeah, exactly. But it's kind of a moving target, correlations, though. So are you afraid, like, to adapt something too much, and then you see that they're
Got to
diverging?
understand what I use. Yeah.
What?
I've got to understand what I use.
Exactly. Yeah.
And if there's no reason to change it, if I start using something else, then unless I can back test it, then I don't want to be surprised by something.
Yeah.
I can blame something I know. Quite happy to blame something I know and say, well, that's the fault of what I do. Just take the hit. But I don't want to blame something new because I haven't done enough research or there isn't enough whatever. Anyway, let's move on. Let's how else more specifically can you trade confluences, convergences and divergences? Do you want to put up a video, Linda Raschke?
Yes, I can. Just give me a second.
She was interviewed
hopefully
at
we can play it directly.
Money Show or something.
Yeah. Let me just full screen this. So we're running from a computer here, so let me just check that it's okay. So it should be loading.
My guest today is Linda Raschke. We're talking about correlations, or the breakdown thereof, of a lot of the markets that used to be correlated are no longer. We're going to talk about that. So, Linda, why are we seeing a breakdown of correlations and things that used to move together all the time?
I don't always know the reasons why. We can observe the changes in relationships. I'm sure that if we're addressing the fact that you used to have baskets that were the risk on, risk off trade, inflation, deflation, however you want to verbalize it, there was a time where gold and currencies and crude and commodities in general were more highly correlated, and as of about I would say May 2012, we started to see a significant deterioration in those correlations, and we're still seeing that. One source that I use to monitor them is more research centers. MRCI gives free research on there, and you can go and look at the correlations going 30 days back, 60 days back, 120 days back. The important thing, there's two important things for a trader to be aware of. First of all, humans are much better than computers about noting changes in relationships.
That's
so that's
so
a
true.
positive thing that you should take to your advantage, that we can recognize breakdown in relationships, and it could be intermarket correlations, could be relationships in PE ratios or yield curve relationships, a lot of different things. We're better at processing the relationships and the changes in them in the computer. And you see this every year. There's new markets which are focused on, in terms of dominating market psychology. So just be aware that these relationships do change. It's very seductive to get used to. For example, here's a great relationship that just broke down. For about 3 years running, the Canadian dollar was 96 to 92% positively correlated with the S&Ps. Okay, as of January 2013, that relationship had broken down to being about 46% positively correlated. So if you're used to trading the market off of the...
Wait, did you have a comment?
Yeah, yeah, I did. That's a very good point, because I believe, maintained at the time, people will know about what I've been saying about the paradigm shift in dollar Canada. That was one of the key lead indicators. The breakdown of the relationship, the correlation between the S&P and Canada was actually the trigger, the warning that dollar Canada was going to do something special, I think. I've got a chart there somewhere which is jumping out of it. I forgot she made that point, which is a really good point. If you can see something like that, you've got to just say, why? Could that mean something? Often it means nothing. Can you let her run again?
Sure can.
Price action in another market, which a lot of people do get used to doing as sort of a little confidence, confirmation type of factor. These things do change, and I will always know why after the fact. Like everybody else, it's like news and fundamentals. We'll always find out after the fact.
Do you trade them? Do the divergences between the correlations, or when they come back together, is it something you use as an actual trade, or is it more just something that you're keeping an eye on for the overall market trends?
No, I don't believe in trying to arbitrage stuff to come back into line to a certain regression to the mean type of thing. And the reason is because I think what's far more powerful is recognizing when a relationship diverges. So if you've had something that's traded in a band, let's say between 20 to 30 to 20 to 30, we'll just talk about some spread differential. And, when you see it's 22, it's the low end, so you're buying it to sell it when it gets back up to 25, 26. What's far more is important is to recognize now if it's outside your band 20 to 30 and it's trading 34 to 36, you actually want to be positioned in the direction of that changing relationship. You don't want to try and arb it and sell it hoping that it goes back into that band. Is a very powerful reason why a relationship changes. Extremely strong supply-demand factors or some significant underlying fundamental cause. So if I'm used to seeing 20 to 30 range, now something's popping 34, I actually want to be positioned so that it goes from 34 to 45, whatever that relationship is. So I think that's a very difficult thing for people to do with human nature. We kind of feel comfortable in our zone, so it's recognizing when relationships...
Do you want to comment on that?
No, in fact, I think Blake's around now. So can you bring in Blake? Because I think that ties in quite well.
Yeah, I'm going to bring him on right now.
While you do that, I kind of disagree with what she's saying there. I've traded a number of times. You getting hold of him now?
Yes.
I've traded both ways. The convergence, it gets out of sync. I've done Euro Swiss so many times. Uh, when it gets out of sync, knowing it or believing that it's going to revert to the mean, and that when it blips 5, 10 points outside, as you described it, then I hit it, expecting to go back in. There've been other times when the market, the yen was a classic example, it broke correlations last year, when you go with her approach. It depends. If you can identify the causes, then you know something's triggering the break in correlation, then you can go with the break. If you don't, then more times than not, you're better off going with the correlation.
So, Ed, we have a guest here now live on. Might be it's an old friend of yours, I believe. Say,
Well, less of the old. Blake, is that you?
so Blake, it's a little hard to get it on the both ways, but
I don't hear him.
no,
I
that's the
can't
problem.
hear Ed.
That's probably a good thing.
Yeah, that's probably a good thing.
Well, can you? Oh, that's a shame. So
Yeah,
Blake
yeah.
can't
So
give me a talk.
Blake and Ed, it's a bit of an issue. I was this was a last minute setup here. It's our first ever second guest on this show. So what's your do you have any questions for Blake, Ed?
Yeah, just well, first we've been talking today about correlations, and just heard a woman, Linda Rashke, saying that she, tends not to go with convergence of, when the correlations work, she trades them when they break. So I kind of like, if he does Blake use correlations, and the other thing, is there anything he's seen today that can be
So
of
Blake,
use?
I'm sorry about this. We're doing this. It's a last minute. We really wanted you on. So Ed
Oh, no
wants.
problem. No problem.
Ed's wondering if you use correlations. You might have seen the video we had up, and if you see any correlations today which are interesting.
I guess one of the things that I've been monitoring as of recently is the lag in the yen pairs, as the yen typically tends to weaken with equity market, risk on appetite, if you will. So, as the stock market has been rallying over the last few days, and even the Nasdaq to new trend highs, the yen stopped weakening a couple of days ago. So I've been playing on that, and really now at this stage in the game, since I'm long yen and I've been long since about Wednesday, I'm watching that correlation break down. But it's working in my favor, because as soon as the stock market pauses and pulls back, it should weaken the yen, or it should strengthen the yen, as many traders have been trying to play into the yen weakness. And so the correlation, I'm playing the correlation, but I'm playing the divergence of the correlation, which is another way of trading correlations. And that one in particular, I've paid, well, obviously I'm trading right now as well, but paying very close attention to. And now all I'm waiting for is just a little bit of a pullback in the equity markets. If the equity markets can just stall, come back down, I think the yen will probably push. Like even overnight, we came really close to 101.50. So.
I agree entirely with you. Blake will know that. There's a couple of things. One is, I don't know if viewers probably won't know that, as did you catch one of the correlations? The yen does move the stock market. The last part of the stock market rally, the yen stopped moving. Did you notice that? Which is Blake's point about the divergence. It stopped moving, which for him, as a buyer of yen, was an opportunity. He was saying to me about overnight, he was looking to fade it, and it was spot on, and it was the right trade, and it still is the right trade. If you look at what I was talking about, DAX, this has been giving us a clue that in the market, the rally is not going to be sustained for at least 24, 48 hours. Can you ask Blake this question for me, Sfrey, is what does he read about dollar yen being lower, but not euro yen and sterling yen being strong? Is that a further divergence in the correlation?
Hey, but I'm just repeating a question here from Ed. We're doing it's like the whisper game here. So, what's your take on dollar yen being lower but not euro yen?
Well, first of all, I trade the yen pairs as yen pairs. I don't trade the yen pairs as in relationship to the dollar. So whenever if I ever get into dollar shorts or dollar longs, I'm usually excluding the yen. The dollar yen is not factored into that equation when I'm trading. So basically, whenever I trade the dollar yen, I'm trading because I believe in yen strength or yen weakness. That's the predominant reason for me trading the dollar yen as a whole. So that means that usually the euro yen is going to move. It's going to move, in the same direction as the dollar yen for the most part. So if I believe the dollar yen's going down, I think the euro yen's probably going to go down too. I think the severity of the move is obviously dependent on how far the euro dollar can rally. And I mean, everybody should know this if they're not aware of it already. There's a multi-year trend line that comes into play in the euro dollar, comes in right around 138.50 or so. So because of I imagine the euro dollar is going to face a lot of selling pressure come another 100 150 pips, that any upside in the euro dollar is going to be fairly limited. So if the euro dollar does slump, let's just say to 100 yen or below, I think it will, to some extent, take down the euro yen with it. The severity of it, again, is all dependent on risk appetite. How if stocks are relatively benign, or if the stock market does fall fairly aggressively, then unfortunately the euro yen is going to be a product of on lower prices because of risk appetite. My assumption would be.
That's interesting. It's very keen to ask Blake, or Blake can hear me. I don't know. What I'm of the opinion, I think I'm not sure whether Blake is, that this market is a market that's going nowhere fast, and therefore are the correlations more likely to hold together, or I actually suspect, and then my question is, do you think the correlations will continue to diverge like this and provide us with opportunities in what is a consolidation market? The blunt of the question is, if it's a range market now, does that mean correlations will continue to diverge and give us opportunities?
Yeah, so we're continuing the whisper game here. If this is a range market, do you think that what do you think correlations, how will they develop from here?
It's a great question. A year ago, actually over a year ago, I had Kevin Ferry of Cronus Futures on my broadcast, and he had told me at that point in time correlations were going to go out the window for 2013. I really wasn't really biting on his analysis at that point, but he'd been spot on. The whole year of 2013, the market really uncorrelated, and I don't know if this year the market's going to recorrelate, because I've told our traders for the last 2-3 months we're in a digestive, or I call it indigestion phase of the market, where we've just taken in 5 years of massive stimulus here in the United States. So as we are pulling, are retracting or reversing monetary policy to a certain extent, the equity markets and the capital markets really have to take in what has just happened over the last 5 years. So we're going to have a lot of what you would consider range-bound type of activity, and so I do agree. Now, how correlations are going to respond to that, I think that they might continue to be a little cattywampus, if you will.
So Blake, we have a surprise guest for you here. I don't know if you can say hello here.
I think I hear Chris in the background.
Yeah, what's up, Blake? How are you?
I'm being a bit naughty,
hey, what's happening, Chris Baird? How you doing, buddy?
Really good. Thanks. I hope you're well too.
I'm doing really well. It's unfortunate I can't hear Ed, because we would just probably go off the hook right now.
So let me see if I can.
Ed having technical difficulties?
I'm trying to add Ed into the conversation here.
Okay.
Ed, if you just hang up with me right now, and I'm gonna add you.
Okay.
I'm doing my best here to live improvise.
No, I think that might work.
But the thing, can you guys see me?
Yes, we can see you and hear you.
Oh wow, then we are in trouble, aren't we, mate? I thought I wanted to spring Chris on you, Blake, because I know he hasn't been around much. I've been missing him. He's I know a lot of people on Twitter have missed him a lot. It seems to be a common thing. Where is Chris? Where is Chris? Well, the guys. Chris, tell people what you're doing.
Oh yeah, I'm just building, and I'm building an office and doing some stuff here in Brazil, and it just requires a lot of attention. So and you know, everything I do is 24/7. I go full bore. So I trade and do that. So I've been taking off a little bit.
I should explain, actually, some people who don't know Chris or Blake or me for that matter will not necessarily understand how Blake's. So this is kind of my way of repaying Blake a compliment. He's had me on his show a number of times, and Chris, because Chris was doing the Morning Edge on Wise Trade. I'll get the plug in there. Check it out, guys. He's been on there. He's done quite a few shows as well, and I've been there. So it's kind of a few people joked that we were the Three Stooges, and since we were talking about the correlations, I thought it'd be cool to get someone like Blake who's really good about correlations and how you use them. And since Chris, you've been away, mate, I just wanted to surprise Blake with you.
Oh, that was so awesome. The last person I expected to hear this morning was Chris Bear. So that's great. It's wonderful that you guys can get the Skype to work too. So. As you guys know, my broadcast starts in about 7 minutes, so I can't stay too much longer. But I want to say congratulations with Big T to you gentlemen over there. It sounds like it's going really well. I've been able to tune in a couple of different times. It's tough for me because of I live on the West Coast in the United States, so it's a little bit more difficult, challenging for me to be able to tune in. But I want to say great job there. And
Blake, thanks.
Yes.
Before you mislead anyone, you live in Arizona, mate, not West Coast.
We're considered West Coast, just the hot part of the West Coast, I guess. You're right. I do live in Arizona, but I'm on West Coast time, which is totally unfair. I have no ocean, and I'm on West Coast time for the most part. So.
One thing I appreciate, one thing I really like to hear about from you, I mean, I couldn't agree more. I always listen to what you say because you're one of the few guys out there who've got a good idea of what the market is doing in its entirety, the relationships. So what I like, and I'd love to get you back, is to get the occasional input as to how your first view. Because I think when I walk in and look at all the markets, I immediately notice, and as the lady did said in the video, notice if something's out of kilter. And it starts making me think. So if we could get some occasional first thoughts from you as to what the market, not necessarily is doing, like, you get the smiler guy saying the market did this and that, but you just say, what, like you did, there's a divergence in the correlations. It may be saying that, maybe not. I don't know, I'll have a look and maybe come back another time or people tune into my show. But I find that's invaluable. And then we just need to get Chris back into the frame, and once he stopped building his dealing room, we might be able to have some fun again.
Yeah, and I just wanted to say, how about that cat?
Dollar Canada.
How about it?
That was some rocket ship, huh?
It was, Chris, and you know what? You look at that multi-decade trend line, you know that thing's going higher. It's just a matter of time now.
Yeah, it was just extended.
Oh, yep.
I think Ed and I and you and I had talked privately a number of times how we've been hunting that when it was below 1. So,
well, glad you called it, Chris, because I was slightly worried that your timing was impeccably bad, that you disappeared. Where you went to build your dealing room when Dollar Canada exploded. I thought, in fact, it might have been why, because you disappeared, that Dollar Canada felt free and easy.
Oh my gosh, that could have been the case. That could have been the case. They thought you were gone.
I just like to say one thing about the market, just real quick. Talking about correlations, everyone's talking about the recovery, it's starting, green shoots, and they don't want to say green shoots because that's a word that's was overused and green shoots died. I'd like everybody to take a look at and think about energy usage. energy demand, and there's no growth, and there's no, if you consider +1% growth, you're kidding yourself. That's stall speed. So just take an eye, keep your eye on energy usage, and that'll. There's no economic growth. There's nothing happening economically without energy usage. So just keep an eye on that, and keep an eye on the slope of the demand usage chart, and you can throw any kind of moving average on there, and any of the common ones, 50, 100, 20.
There's be someone in South America who's been building an office in Brazil, probably using the extra energy. Are you about to go where now, Chris? Can we?
Oh yeah. I'm gonna head down to Argentina to look at some stuff down there, see if there's any opportunities. I'm leaving tonight, actually.
Cool. Well, good luck with that, and you're not going to be burning any more energy then. That's the main thing.
No.
So we're going to get you back. We're going to get you back fighting fit, back in the markets, if not in Twitter.
Yeah. I don't know how active I'm going to be on Twitter again, because I just find it to be somewhat draining in some ways. But at the same time, I don't know. I got to figure out how to use it again. It's evolved a lot, and maybe it's evolved without me for a reason. Maybe I'm a dinosaur.
Well, no, you're not a dinosaur. One thing you are, Chris, as you said, you're 24/7, and maybe you give too much of your heart and soul on something like that. Which I know people like. It's Blake. He just gives, and rightly get some praise from a few. Well, not a few, from a lot of people. But you wonder sometimes why you give so much when people should arguably be more grateful, because what you provide.
Especially a guy like Blake, for example, he gives a lot, and then he gets the snide comment or the pot shot tweet, and I'm just like, where's this guy at? Why is he thinking? I mean, Blake is one of the nicest people in the world. He'll take time out to talk to anyone. He'll put your head straight regarding trading. If you're over leveraged, many things he'll help anybody with. And there's these guys abusing him. I just don't get it.
I figured out what this block feature was at Twitter, just this last year, thanks to you. So it's been good. I've used it times.
Is that why you're ignoring my messages?
Yeah. I actually have you on your own stream there, Ed.
Wait, you've got 60 seconds, bro.
I know. I gotta go. Hey guys, Sever, Ed. Congratulations, Chris. So great to speak with you, Ed. It's always wonderful to speak with you, and I'd love to, jump on, sometime and maybe give you some comments, or maybe can chat about just some things we see in the market from time to time. So thank you guys so much for having me on. I really appreciate it.
Oh, thank you, Blake, and Chris. Good luck, and keep in touch.
Okay, great guys, and then Blake, great talking to you.
Same here,
thank you for having me stop in.
Thank you. And
any viewers who wanted to get some serious stuff on correlations, you got a bit of it from Blake, but no, it's just I wanted to bring Chris in because he's a good friend of Blake and he hasn't been around. So thanks, guys, and good luck. Speak to you soon.
Thanks for the reunion. All right, see you guys.
Okay, bye.
So Ed, you're still there?
Yeah, I'm still here.
Let me call you back from the other line so we get you back on video. So that was our little bit of live improvisation here to make this work, to get the reunion up and running.
Yeah, sorry, mate.
No, but I'm so proud that I got it to work.
Yeah, no, well done. Yeah, I do challenge you sometimes in more ways than one.
Yeah, that was something out of left field here. So
yeah, it was very self-indulgent on my part. But I just wanted, I said I thought it'd be nice to get Blake because he's got a good eye for correlations. And I thought, well, if Blake's coming on, then I do speak to Chris, even though he's not so around on Twitter.
Yeah.
And so I thought just surprise him because he hasn't been around much because he's been building that office. So it was an opportunity to bring them both in.
Yeah. No, it was great, and that was like an immediately great conversation. So that can't be the last time.
No, it's funny because we haven't met, but we should get together for a couple beers. Anyway, Where were we? In fact,
I have no clue. I'm like my pulse is at 180 from multitasking here. So
well,
yeah.
that's the nature of correlations. That's the nature
Yeah.
of this myriad. There's thousands of relationships out there that correlate. Is understanding around multitasking because that's what it involves.
Oof.
But
Yeah.
it's, I think there's a lot to be had by getting someone like Blake on, just to
Yeah.
say,
No,
what's
it
first
was
first glance, what's
genuinely
the
a
first
nice
thought?
conversation just to sit back, mix, and listen to you guys. That was good.
Yeah, and kind of that's where I was, where I was heading because it takes someone like Linda Rashke. She says she was only going with the breaks. There's a number of things. Blake was talking about a divergence of correlations, a momentary divergence, as saying, well, I think it's momentary, but saying that things aren't as strong as they should be, which is why I think the yen crosses. I produced a video on marketvisiontv.com yesterday on euro yen and one this morning on sterling yen, giving what I think is a really clear, for the first time in weeks, if not months, the yen crosses are just shouting. To me, they're shouting, and it means I'm trading both ways on it because and it ties in with the idea there's the correlations are weak which when the market is, if you go back to the bull market, that we're in, and it's been really when it's been really strong, it's correlations have been strong, and correlations are typically strong at the a major top as well,
Yeah.
and we haven't seen that. So it places us in the moment, arguably on the weak correlations in a correction. Well, take that big picture view on the stock market and apply it to the yen crosses short term. Apply it to the you notice how DAX is at new highs today, but the S&P and the Dow certainly isn't short-term highs. So that's creating the correlations are all weak. And that happens, to me, it's saying, just watch out. There's an opportunity here for a play. I mean, and a play both ways. To see, I think it's going to be a drop in the, as explained in the DAX. I think it's an opportunity later in, or now and later in the yen crosses, but check out the videos I'm doing there. So that's one way of playing it. You can trade the convergence, you can trade the break, you can, interestingly from Blake, you can trade the breakdown, the divergence in the correlations, not a break, but a divergence. We saw with something like, using something like the breakdown in the dollar Canada S&P, correlation as a trigger to leverage what has been a great trade. When correlations work, when these come together, it doesn't have to be the whole series of everything that correlates comes together, but often it is. Or when a number of different markets are correlated or can be correlated, they come together. What it does do, it provides you with confidence. It provides you with a narrative. It gives you the ability using my metrics alone gives me the ability to leverage. And there's a great quote from Jesse Livermore. What a surprise! I'm going to get Jesse into everything, every show he ever did.
Would be great if we could call him in as well.
Well, that would be quite an achievement, wouldn't it, if I got Jesse Livermore onto the show?
Would you be able to? I mean, there's been some chatter about somebody should make a Jesse Livermore movie. Is there a script of anything?
Just doesn't,
No, but there's so many good. I mean, at least there's short film or something.
People want, the people want they want the glitz, don't they? And he wasn't a glitzy guy. He was boring. Maybe, he's obviously shot himself, and his whole family have been hit by, tragedies.
Yeah, after him as well.
Yeah, the Jesse Livermore quote. Can you put that up, or is that now no longer?
No, everything's operational. I just had to get my pulse back. I'm sanguine again.
Yeah, so Jesse, when all the factors were in his favor, this is talking about the trader, when all the factors were in his favor, when he was patient and waited for all the ducks to line up in a row. That's what correlates. It's not actually a proper sentence, but I wanted to focus, basically, that's when he went for it. That's when he made his money, when all the ducks were lined up. And the ducks come in the form of correlations. On relationships, you can see, well, that's working, that's working, that's working. Using my metrics, it gives me leverage, tells me to leverage, but it gives me the confidence to leverage as well. And that's what's so powerful about correlations. You can trade them every which way and lose when they don't work. But it's and I just there's some really interesting ones. I know that you were out at dinner with a fund manager last night talking about correlations. You came out with some clever ones. You got any fun ones there?
Do you want to bring the ones in the chart, or do you want to bring other correlations?
Well, I just thought you might have one or two interesting ones.
Yeah, we
But
have some. What was the
let's
correlations there, Michelle? You have a few correlations in hand that you did some studies on right now, didn't you? We were
I've got
doing
some.
studies
If you
right
want to
before the
give,
show here.
you got a couple minutes or whatever. There's
What did you
the
say? Yeah, we actually tweeted this out on the account called Structured Research. Let me bring that up. So it's already out there.
there's
Uh,
cross referencing.
yeah, this is brilliant. It's also one of our shows where we do. Let me bring that up. So we're multitasking like crazy here today. So
Well, if you want to pick, you can pick. You can pick any of the ones I've got there. The ones I haven't shown yet.
yeah, the iron ore and Brazilian stocks is quite good. Can bring up the chart here.
What's the reasoning behind that? Is there one?
What is the reasoning behind that, Michelle? Yeah, because they have a huge steel company, Vale, yeah, and it's such a big part of the economy. I suggest is the reason. So it's a very logical
Causal.
correlation.
There's a causal correlation. Yeah, so it works.
It's like Norwegian Stock Exchange and oil, which is fairly correlated.
Get away.
Yeah, it's crazy, right?
Did you? I don't know if we ever got. Let's choose. Can you throw up something like Aussie and gold? My Aussie.
I have Aussie and Shanghai, which is fairly correlated. I don't know if you can tell from this, but it's
more recently. Yeah, you see,
yeah.
I wouldn't get a bunch. The scaling's wrong on it. To highlight it, you can see it is.
Yeah, it's interesting.
Well, that's kind of like a Far East global asset class, then, isn't it? What about, can you put up Aussie and Golds, the one I've got there?
Yep.
One I've taught and we've put up before, about the 590 hours difference. That baby's worked a treat. What it does do, it highlights some strange reasons.
Yeah, there we go.
Yeah, I mean, and yeah, people will know that gold went higher and the Aussie's gone higher, and we've been tracking that. You know, it varies in time, but it's basically gold has led the Aussie higher. And that's one of the, for me, one of the interesting things. And I think if you can understand why something like Canada can be 10 months behind gold, why the Aussie can be 590 hours or sometimes shorter, only 10 hours behind gold. If you can understand why that's the case, then I think it'll be better, even not just understand correlations better, but we'll have a much better understanding of markets. My belief, for what it's worth, is that there are so many variables out there, so many reasons why things happen, and it takes time to happen. So someone says, well, they're related, and then they take a decision, and they got to go through a decision-making process that they actually think, well, gold is bottomed out, it's time to buy gold, and therefore, the decision-making process to filter through the causal link, they buy the Australian dollar. And the reason why that might not be apparent is because there are so many other influences. Might be the SEMP RBA, trying to, talking about intervention lower. There might be monetary policy having an effect, the timing of it, the RBA doing something different there. There might be the stock market is coming off at a time when gold might be European risk, and therefore gold going higher and risk assets, and therefore the Aussie going low, confusing the Aussie, could delay that to fruition. There's so many variables out there that it's my belief that something like when Barry Ritholtz says they're not correlated, they are correlated. There's just so many other things in the way that the correlation doesn't stand. You can't see it. It's not simple. Strip everything out elsewhere, it would be correlated. There's so much else in there that it never appears to be correlated. Yeah. And therefore, from a trading perspective, it can't be used.
I think what he's getting at is, because I know this a little bit around this this quote here, and there's been a lot of talk from him and people like him, people he work with, and it's often the point is often if you look at a site like Business Insider or something like that, and you're talking about the economy and people are like going back and forth between the stock market and the economy, and it's it's seen as the 1% getting richer and all these things, and I think people just misunderstand like how macroeconomic numbers drives the stock market, and it appears that this whole new breed of macro watchers after the credit crunch has started sort of confusing the two. I think that's
Yeah.
the point behind that, because trading a number like we've seen with you this week, when you trade a decision or a number, it's often very complex reasoning behind it. You're looking at like an ABC kind of a like because of
Well,
this and
it's
that
not
and
so
this.
complex, Ferry. What it is the complexity. I made this point a number of times before, and I guess it's one of the driving points behind today talking about correlations. Is the world is complex. The world is extraordinarily complex. I don't think any one computer, any one model, certainly any one brain can't handle it. But what we try to do is simplify. And when you simplify, there's always a risk that you don't simplify the reality, the truth. You go off in one type, you splice it, so you get a bit of the truth, but not the whole of it, and therefore you get it wrong. And the problem with correlations, the problem with the real world, is shifting so much. So you have a story, you have a narrative, you have analysis that tries to match the reality. So it's not necessarily going to be simple. But when it comes to trading, then it should be simple, in my opinion. That's when, because you need to control the risk. And the risk is, you can have wonderfully complex risk models, but from a trader, certainly the type of trader that I am, it needs to keep it fairly simple. Some people think I'm quite complex in how I trade, but you need to simplify the risk as trading in order to concentrate, crystallize, and simplify your risk management. And in doing that, then it is complex. When you see the stories, when you see the numbers coming out, and you see last week, I was looking to buy the dip, and dollar Canada was doing something different, something interesting. There's a correlation that went that day in dollar Canada. I was highlighting. I wasn't saying correlation, but I was highlighting. I was looking for the markets, an opportunity to buy the stock market, and therefore I was looking at a range of things that were correlated. And dollar Canada broke the stops, and therefore said that was an indicator that the market, the drop. Again, it's a correlation break that highlights an opportunity, that the dollar Canada breaking lower, because that's a risk appetite type of thing to happen. That was an opportunity that the stock market would actually rally on the back later on the back of NFP, and it kind of worked. So
But that's exactly what I mean. It's like you have this sort of a filter, like a trading filter. You sort of you weave everything through. So in a certain time of in the market, the risk on, risk off was the filter. And since 1987, it's been buy the dip. That's been kind of a popular approach, and especially in the last few years, that's been successful. But is that an apt way of describing how you like if you take Barry's
yeah, it
quote?
is. That is, and that's why someone like Blake, having Blake on today was really good, because if we can get him on some more, because well, one, he's a nice guy, but and we like nice guys and girls, and but also that's a filter. That is an American filter. And it's interesting, if you want to know how the market will move in New York, you want to get an American filter, because you want to find out what the archetypal trader will be thinking. Not that Blake's an archetypal trader, but he's got a good read on what the archetypal, the average trader will be doing, and he'll be using his filtering system. So, he can pass that information on as to what he thinks the market will do on his take. And then I can factor that in. I like talking to people in the States to get an idea of what they're seeing. Or if I can't speak to anyone, I then put my mindset of walking in. I'll try and do a Blake and see what's so obviously different and what people might be thinking in terms of correlations, but also how the market will move, and then make decisions on the back of that. So it's...
And one thing that was interesting, because I don't remember if we touched upon it, but it was when it was the Fed, I think it was last week or something like that, and we talked about like how much is the Fed gonna, I think it was with with Harry Daniels, and we talked how much is the Fed gonna factor in emerging markets, and that was his point of view. And then I saw an American with the same exact, and they say we don't. Well, he said it in one way.
Yeah, it was interesting.
He doesn't
the
care
question
at
was it
all.
Fisher, wasn't it?
Well, no. It's a person who said we don't care at all. Like Americans don't care at all about the rest of the world, and that was like, just a different perspective was so interesting because they really probably don't care. And I would never have guessed that.
Yeah, no. Everyone's parochial in a sense. They look after their backyard. Mine's very wet at the moment, and it's not a backyard, that's for sure. I was actually very tempted to tweet a picture of on part of my run. It's in my backyard. There's a massive lake, and it's going to be even more massive. But anyway, that's beside the point. So it's
that's
a bit
scary.
threatening.
Is it really close?
Well, it's getting closer.
But how's the forecast looking?
No idea. I have no idea. I'm not going to be around on Monday, guys. I'm going to be out.
Yeah.
It's very.
So I'm guessing we're gonna just take some time off, both of us.
Yeah, and I got family outings, birthday and stuff coming together, so just take some time out. But I hope it's been interesting because I find it interesting looking and thinking through and trying to rationalize some of these things. I do. I know, when you've been around a lot, and there's actually something I was thinking of doing in some of the stages of being a trader. One of the things you do after you've been around a lot, things become second nature.
Yeah.
And sometimes it's useful to, what's the word? Well, to analyze, isn't it? To break it down, to fragmentize it, to break it down, strip it down, that's it. And what you do, because sometimes you're not always conscious that you develop things that actually kind of work, but I'm not aware necessarily of everything I do. I know I look when a market, like Blake, I look at a market when I first come in a certain way. I've never really talked about how I do that, which is useful, I think, might be useful to someone who's, a relative novice of how, the markets, it's interestingly, I do use correlations.
Yeah.
Well, the first things I do is I look at the correlations because there's no good looking straight away at, say, the euro dollar with not realizing that, and then dollar yen, without realizing that the yen correlations have gone out of kilter in Asia. And it's happened in Asia, and therefore that might be significant. So I need to look at that. I always start on the fringe and work back in.
Yeah.
I start with the correlations. I need to understand the framework on what I'm looking at today. And if the correlations are fine, then I know the story is pretty much as it would be. If the correlations have moved, I then need to factor that in and just put it aside, then look at everything else, and then maybe factor that back in. Does that make sense?
Yeah, no, I think it's brilliant, and it's really fun to see, because I'm truly not being a trader and being on a daily trading show is kind of maybe a little bit of a strange setup, but I think it's also, I am kind of a little bit of a filter for the people who don't trade, and you're coming from a completely different approach, asking some questions which are maybe unusual or that. Stupid is another word.
No, I draw on the fact I've said to you, I've accused you of not being a trader, which is a bit unkind. You're very good. It's very really good as a filter, because you understand. Very bright guy. Understand some of the complex things. Certainly some of the things I talk about and think about, but also you articulate very clearly, and also because your background isn't or hasn't been trading, then you do kind of bring that perspective, which is useful, because I take a lot of things for granted.
Yeah.
I said it before, I don't take any prisoners. I don't want to take any prisoners. If you can't keep up, then I'm sorry. I try to explain things as clearly as I can.
Yeah.
You can't explain everything always. But and correlations is really a complex field, but it's so important.
Yeah.
So
we're running at an hour and a half now, so we had viewers the whole time, which I find amazing for an hour and a half, and quite consistently. So it's been very high quality today, and it's been like the time has flown by, and we still have a lot of content that we actually hadn't been able to show because of the the talk with.
We'll show it next time. Yeah, I had a clip from John Murphy's Intermarket Relationships.
Yeah.
But yeah, there's lots of stuff but that's the nature of the beast. Yeah, it's
Exactly. No, I liked it like this. It was brilliant. It was very interesting to listen to, and I love the fact that we got to see you with your old mates that you actually have never met, which is an interesting part of the internet.
Yeah, it's very interesting, isn't it?
So I'm gonna spring a chart on you.
Me? Yeah. Then
you find this interesting, and is it correlated?
Oh.
I don't know if you can read
it. Looks. Are they exactly the same timescales?
Yes. It's just lifted from Bloomberg. It's Louis Vuitton and China. I don't know. It's some Chinese index. Shanghai stocks, which you would think should.
Yeah, it's interesting. I tell you what's really interesting is, and it's this is a case of fractal eyes, because with the correlations, they're very similar charts, and therefore they fit into that category of fractals, and there is they look slightly different because can you zoom back in so I can just pick the date, because I don't know what the date is, and then I've lost. Can you see the
I think it's a yearly chart.
It's around November. The green line goes up to the highs. Yeah. That distorts a picture because that's when the correlation broke down a little bit. They are correlated. They're also a fractal, and I think the green line is leading the other one, the top one. And I think the moment that the breakdown in the correlation in November has distorted what could be a leading indicator. I don't know what the green line is or the chart is, but it looks like the green line is ahead of.
The green line is Shanghai. The blue chart is LVMH, the luxury conglomerate.
So why would the luxury conglomerate be affected by the Shanghai index directly?
It's their biggest market. So it's just
that'd be interesting. That'd be interesting. I mean, that immediately. So it's part of the Shanghai index, yeah. I'm actually long, so I should know that. I should have recognized the charts.
I think we have reached the way's end, and I want to thank Ed and our other guests for excellent broadcasts and excellent end to the week. Do you have anything to say in your closing statement?
Well, yeah, actually, I forgot. We were going to use Friday as to go through lessons learned on the week. I think there's two very big lessons from this week. The first one is when your diary says it's a quiet week, don't always believe it, because there's been some good moves. Sometimes, in fact, when it's a quiet week, it allows the market to do what it wants, and you don't have risk events or news that people are waiting for holding it up. So it just gets on with it. It's hence the point about you can sometimes see the real trends in quiet weeks. And the second thing is, when you're in doubt, just stick to your plan, your original plan. And I think for me, that's the lesson of this week, is that the plan has worked because I've stuck to my plans. The plan has worked because I stuck to my plans. It's worked because I've been disciplined and kept to, like the DAX, even caught some of this Eurodollar move because my system told me the risk return probability on the Eurodollar was such that, I was fading the rally, but as it came down and everything else, we were flipped. Actually, we was able to catch some of that move because the system said it was, even though emotionally I wasn't with the trade. I still caught it. So it's that's basically lessons learned. Is there's always a quiet before a storm. Is that the one?
Before the rainstorm?
Yeah, I don't know. I actually think correlations and sentiment are going to be the way for the next few weeks.
Yeah, I think you're right.
And the breakdown in the correlations and divergence is going to push them to the limits. Could be interesting. Interesting times. Well, very thanks, mate, and thanks everyone for tuning in.
Thanks for a great weekend. That was just fun and educational, and we got to test ourselves a little bit in this live environment here.
Well, that's the point, isn't it? At this stage, when some of the clever things we want to do that would be even more challenging later.
I think what we did today is maybe one step in the right direction.
Yeah, exactly.
It felt right. I liked it immediately.
Yeah. But well done. You did a great job.
Yeah. And now I have to run, I'm sorry to say.
Yeah,
so
likewise. So
this concludes the end of this week, and I want to thank everyone for tuning in, and our audience is growing slowly. We have some new distribution, so we get like new kind of audience, and I want to thank everyone for tuning in.
Have a great
Peace.
weekend.
Love.
See you Tuesday.